Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So as the markets are very volatile at the moment, what I like to do is look at the overall markets and find companies that we could potentially add to our portfolios. Now that is, we look for high growth companies, we're looking for dividend growth companies, and we're looking for companies that will kind of the consumer staples, that the defensive kind of companies as well. So variety of companies that we talk about here are, we do these things on purpose. So what I'm going to do now is I'm going to talk about 5 different companies that are dividend aristocrats. Now, first of all, dividend growth strategy, I would say, is probably one of the best strategies out there when it comes to investing in the stock market. The reason I said that is because a lot of the companies that are dividend growth companies are still growing their revenue. They're still on that trajectory of still double-digit growth in terms of EPS and so on. And on top of that, they pay in dividends that are growing every single year. I'll give you a couple of examples from this portfolio. So if we look at companies, for example, Intuit, and companies like MasterCard and Visa, MSCI, all of these companies are what I would like to call dividend growth companies. They are still growing double digits. Some of them are, still fairly valued. And on top of that, they grow that dividend every single year. They're growing their EPS double digits, and of course, they will continue to do that. S&P and Global is a great example. Procter & Gamble is a great example. But about this one, the growth side of it is not a lot. It's about 3, 4, to 7%. But double-digit growth from Visa, double-digit growth from companies like MasterCard, Intuit. On top of that, they are also, increasing that dividend every single year, double digits, which is very, very nice. Even EOG Resources is actually a dividend growth company. So what I'm going to do now is I'm going to share with you 5 companies that are dividend aristocrats. But before we do that, I just want to touch on just the general markets, because just this week, let's just actually go with it just this week. As you can see, we are flat, so nothing huge has happened. The Nasdaq is up about 4%, but everything else, the S&P 500 just about 2%, which is not bad at all, by the way. Better than where we were last week, and we will see how Friday goes. But for the month, again, we're still in the green, which is nice. For the last 6 months, we'll definitely be in the green, but not as much as we were previously. But a year to date is a different ball game. We are almost up 18%, and that's absolutely amazing for the S&P 500. If the year ended right now, we would have made about 18%. Basically, the S&P 500 would have climbed up about 18% for the year, which is absolutely amazing. And this is what we say, on average, the stock market grows about 7 to 10%. So if it's 18% this year, and then 5% next year, and 0% following year, and so on, we take the average, and on average, you expect it basically 7 to 10%. 7 to 10% is better than whatever your money is doing basically sitting in your account, just collecting dust and the inflation eating it away. So that's the reason why I love investing in the stock market. So let's now talk about the 5 companies that we came here for. But just before I do talk about these 5 companies, it takes a lot of time to put together these videos. So I would genuinely appreciate if you can just like the video and subscribe. And if you can, you get access to a lot of things that I've not even listed here. I need to update this list here. There are a lot of things that I share with the community, all the buys and the sales, the dividend trackers, the top, basically I've got top 10 companies, a high quality companies, Sharia compliant, that I've shared with them recently. I have a spreadsheet that basically lists all the undervalued stocks. So I share a lot with the community, and if you can join us, that would be definitely helpful, inshallah. Right, let's now talk about it. So one thing we're going to focus on today mainly is the dividend streak. So that's how long they've been paying that dividend. Like I said, aristocrats have increased that dividend for 25 years in a row. Think about what's happened over the last 25 years. That we have, recessions and all sorts of things, and these companies have actually continually, increased that dividend every single year. Now, Morningstar valuation and we want to see the fair value. I believe all of these companies are right now fairly valued. Okay, the first one we're looking at today is automatic data processing. It's the one that I own in my portfolio, 114 billion market cap, has a wide economic moat. Currently, dividend is just over 2%, and the payout ratio just below 60%, which is fine. Latest increase was 12%, and the 5-year growth rate 12%. But look, check this out, 50 years of increase in that dividend. Now, this company is what we call a dividend king right now. Kings are companies that have increased that dividend every single year for the last 50 years. And not only that, they have to be in the S&P 500. So this company meets that criteria, so they are a dividend king right now. The annual payout is $5.60, 97% safety. 5-year, we're looking at 6% when it comes to revenue and 13% when it comes to EPS. The profit margin, return on equity, and return on invested capital, absolutely wonderful. $3.5 billion of free cash flow right now, and this is money that they use to increase that dividend, for example, to buy back their own shares, to pay off any debt that they have, acquire other businesses. So they can do a lot with free cash flow. Free cash flow for me is very, very important, especially if no matter what, whether you're a growth company or not, free cash flow is very important. If the companies are generating excellent free cash flow, then you will be safe. Your money, is well invested, and inshallah you will make some good returns. But if the company doesn't have free cash flow right now, automatic data processing is actually doing well. But the other one, APD, which is, I get confused between the two, product and chemicals, right now has basically negative free cash flow, which is crazy. So that's something that I've talked about previously, so I'm keeping an eye on that, inshallah. The total return the last 10 years, we're looking about 15%. The growth estimate next year 9%, and then 9% every year after that. Fairly valued right now. $280 per share is where they think the price should be. Now, according to Wall Street, okay, we only have 2 strong buys and 1 buy and 14 holds and 1 sell. Okay, their target is basically flat now, about 1% down from where we are right now. Just to quickly show you, the earnings expectation is moving forward about almost double digits, 8% to 9%. Not bad at all. 5%, 5%, 5%. So this is what you expect from this type of business anyway. The next one is PPG Industrial. This is one of the painting companies out there. Sherwood Williams in this company are dominant basically when it comes to that market. About 30 billion market cap right now. Narrow economic mode, $125 per share right now. 2.2% dividend yield, which is quite nice. The payout ratio very, very low. Latest increase was 5%, and the last 5 years they increased that dividend 6%. Now dividend streak is 52 years, so we have another dividend king here. Annually you get $2.72. Safety 93%, so nothing to worry about. They grew that revenue about the last 5 years about 4%. EPS about 14%. Profit margin, return on equity, and return on invested capital is decent. $1.4 billion of free cash flow right now. Total return in the last 10 years about 4%, which is not great, but it's just 4%, and hopefully it will be better in the next few years because they're expecting the earnings to grow double digits next year, and then year after almost double digits. Now fairly valued, $118 per share is where they think the price should be. Now looking at Seeking Alpha, it looks like it's a buy. We've got 11 strong buys, 4 buys, 10 holds, and 1 sell here. We've got about 20% upside from where we are. $149, about $150 per share is where it should be. Right now it's about $25 off that. Now looking at the earnings expectations moving forward, we are looking about 8% this year or 7% this year. Then after that, we're looking about 10% every year for the next 2 years if we just focus on the first 3. And when it comes to revenue, it's a bit of a decline this year, and then about 2%, almost 3%, 4%, 4%, 3% after that. So nothing huge to worry about, but at the same time, we don't expect these are the type of businesses that grow. They are really old businesses, and to innovate is very, very difficult. So you can't expect a double-digit growth from these companies. If you get it, that's absolutely amazing, but that's basically where they are right now. Next one is Genuine Parts Corporation, and this company has a market cap of almost $19 billion. Narrow economic mode, $136 per share. It's about 3% when it comes to dividend yield, which is quite nice, and payout ratio 41%, again really good. So they've got room to increase that if they need to. Latest increase was 5%, the 5-year growth rate of 6%, and 67 years of increase in that dividend. Another dividend king. Annual payout, we're looking at $4. Safety of 80%, so nothing to worry about. The highest you get here is about 99%. In terms of revenue, they grew about 7% last 5 years. 5 years for the in EPS. Profit margin is about just 5%, which is not great, but the return on equity and return on invested capital is doing really well. Now in terms of Free cash flow, we got over $1 billion. Remember, the company is only about $19 billion, so that's absolutely fine. 7% total return in the last 10 years, which is really good. Growth estimate next year about 8%, 7% after that for every single year for the following 5 years. Fairly value right now $148 per share. Right now is 136. Looking at Seeking Alpha, as you can see, Wall Street's actually saying it's a buy. 3 strong buys, 1 buy, 10 holds, and about 12-13% upside from where we are, $153 per share. Now, if we look at the earnings expectations for this company moving forward, we make basically looking about 1% this year, so year-over-year growth of 1% when it comes to EPS, 8%, 5%, 5%, 7%. So not bad at all. Again, 2%. 4%, which is basically what I kind of expect from these kind of companies. I just want to quickly show you one thing about this company. As you look at this here, you've got $15 billion of revenue to $23 billion. So that is growing nicely. They're spending about $14.7 billion. They're taking home about $8 billion basically gross profit. And then, of course, they have to pay all the sorts of taxes and so on. And then their net income, $1.2 billion. So it's really decent business, well-run business, I would say. Now, moving on to the next one is Abbott Laboratories. This is the sister company of AbbVie, and it's a pharmaceutical company. $404 billion market cap right now, narrow economic mode, and price we're looking at about $116 per share. Dividend yield of just below 1%. The payout ratio 49%. The latest increase was 8%, and by last 5 years they grew about 12%, which is absolutely huge. We've got another dividend king here, 52 years of increase in that dividend. Can you imagine? 52 years, 67. Every single one of these companies have increased their dividend for 50 plus years. Whatever has happened over the last 5 years did not have any impact on these companies, because they are very frugal about what they do, and they know what they're doing, and they do it best. And as you can see, they have excellent free cash flows and so on, which is I really like that. Okay, payout ratio looking at $2.20. Safety 90%. The 5 year in terms of EPS and in terms of revenue, so about 6%. Profit margin, return on equity, return on invested capital, really good. Free cash flow of $5.6 billion. Of course, it's a huge company, but that's really good. And 12% of basically total return of the last 10 years. And growth estimate for next year about 10%, 8% after that. Fairly value right now $104 per share is where they think the price should be. Now, Seeking Alpha and Wall Street are both saying it's a buy. 12 strong buys, 6 buys, 7 holds, and we've got 6% upside from where we are, $124 per share. Right now is $116 per share. If we look at the earnings expectations moving forward, it's about 5%, 10%, 10%, another 7%. And then if we look at the revenue side of it, year-over-year growth of 4%, 7%, 7%, and 6%, which is absolutely huge. And the pharmaceutical companies, that's what I expect anyway. That's quite normal. And just quickly to show you the revenue side of it for this company as well. Total return, basically total revenue for the last 10 years. So $20 billion to right now $40 billion. So double that, $18 billion of the cost of that revenue for this year. And they have taken home $22.5 billion. They've done all sorts of things, and then their net income, they have got $5.5 billion, which basically corresponds to this $5 billion that we have. Final company we're going to talk about today is Clorox, and this is one of the companies that benefited from COVID. The stock went crazy at that point, and people were buying it left and right, and then it crashed, and I don't think it has recovered since. 20.7 billion market cap, wide economic mode, $164 per share right now. Dividend yield of almost 3%. The payout ratio right now is 78%, which is quite high. Latest increase 2%, and then 5 year growth rate of 4%. 47 years of increase in that dividend. So this one let us down, but the rest of them are dividend kings. So 3 more years and this one will become a dividend king. You get $4.88 for every share of this company that you own. Safety is 70%, which is very good. The 5 year growth rate when it comes to revenue is 3%. EPS unfortunately has declined over the last 5 years. Profit margin we're looking at about 4%. Return on equity of over 100%, and return on invested capital of 27%. Now, in terms of free cash flow, it's a small company, but I would have expected at least $1 billion to $2 billion, just like this one here, Genuine Parts company. They've got $19 billion. This one has got $20 billion, and this one has at least over $1 billion of free cash flow. This one's got $483 million. So maybe that's gonna increase in the next couple of years. We'll see what happens. Total return the last 10 years about 9%. Growth estimate next year 7%, 8% after that, which is very solid, fairly valued, $170 per share. 164 is where it is at now, very close to that target. And just very quickly to show you what Seeking Alpha thinks of this company, as you can see, it's all hold here, one strong buy, two buys, 14 holds, 3 strong sells, and 3 strong basically sells as well, and about 8-9% downside from where we are. $151 per share right now. It's over 160. Now let's have a look at the earnings. Maybe there's something in there that, so 8%, 8%, 5%, 7%. So they're expecting to grow the earnings in the next few years, basically based on what we've seen, about that 8%, 7%. So it's interesting, the fact that no one is really looking at this company, but the revenue is expected to decline this year, 2025, of course, and then $2.5 billion, 2.5% when it comes to 2026, and then 2.85%. So again, nothing huge to worry about. So this year, not great, but after that is basically what we expected from this type of business. And quickly, I want to see what their actual balance sheet in fact looks like, the income statement. I want to see their revenue. So $5.6 billion to $7 billion. So that's not massive growth at all. They're spending, they made $7 billion, they've spent 4, they've got 3 here, they've done all sorts of things here, and then their net income is about 280. So this bit here, can you see that? That's sort of a declining, which is not great. And you don't want to basically invest in the company. This is why every time I look at this company, I'm like, it's really good. And then you dig deeper and then you realize that's not really great. And the other thing as well, look at this pop out here. So $4.45 when it comes to EPS. So this is, we're looking at basic EPS, then 5, then 5.4, then 6, then 6, and then 7. I think this is probably COVID. There you go, 2022 COVID, $7.46. Then it has declined, and it has been declining since 2023. 2024 is a bounce back, and then now that's exactly where we are. So maybe this will change in the next couple of quarters, and we will see that. Anyway, I'm going to show you finally the Sharia compliance side of things. Nothing to worry about. This one is probably the only one. Clorox is about 97. If it hits that 95%, then that means that basically we might not even be Sharia compliant. But yeah, that's the companies that I wanted to share with you guys. If you're enjoying this type of content, like I've always said to you, I promise you, it takes a lot of time and effort to look for, you know, these videos and put it together and share it with you guys, editing and all of that stuff. And also the software that we use, we have to pay for all of this software. So I genuinely would appreciate if you could join us at the Patreon account. If you can't do that, just like the video. So inshallah we can help more brothers and sisters out there. Have a wonderful day. Assalamu Alaikum.